Here's a belief almost everyone holds without questioning it. When the market drops, that's risk. The chart goes red, your stomach drops, and the word that flashes in your mind is risk. But that instinct is wrong, and it's an expensive kind of wrong. Volatility and risk are two completely different things. Volatility is how much a price bounces around. Risk is the chance you actually permanently lose. Mix them up and you'll sell exactly when you should be calm. So let's pin down the two words, because the whole thing turns on the difference. Volatility is the size of the swings, how violently a price moves up and down along the way. It's loud, it's emotional, and it is almost always temporary. Risk is something else entirely. It's the chance of a loss you never recover from, or of falling short of the goal you were investing for. One is about the bumpiness of the ride. The other is about whether you actually arrive. Look at what volatility actually does over time. A broad basket of stocks can fall hard, 20, 30, even 50% in a brutal year. That's the part that makes headlines and makes people panic. But then look what happens next. It claws its way back, and given enough time, it goes on to make new highs. The drop was real, the fear was real, but the money was only lost on paper. The chart that terrified everyone was a deep dip in the middle of a long climb. Now here's what real risk looks like, and why it's a different animal. Put everything into one exciting company, and if that company fails, the chart doesn't dip and recover. It goes to zero and stays there. That's not volatility, that's a permanent loss, the kind there's no coming back from. See the difference? The diversified index that fell 50% felt scary but healed. The single stock that fell 100% felt the same on the way down, but it never returns. Same red chart, completely different fate. So how does volatility actually hurt people if the index recovers anyway? It hurts through behavior. Picture two investors in the exact same crash. The first one watches the chart bleed, can't take it, and sells near the bottom to make the pain stop, turning a temporary dip into a permanent loss with their own hands. The second one does nothing, keeps their money in place, and rides the recovery all the way back up. Same market, same drop. The only difference was who let volatility trick them into selling. So let's bust the myth out loud, side by side. The myth says, the price fell, therefore I lost money, therefore stocks are risky. The truth says, a falling price is just the market changing its mind in the moment. You only turn that paper dip into a real permanent loss the day you sell into it. Until then, a lower price isn't a loss at all. For someone still buying, it's the same thing on sale. The danger was never the swing. The danger was reacting to it. So burn this one line into your memory, because it cuts through almost every scary headline you'll ever read. Volatility is the toll you pay for higher long-term returns. Risk is the chance you never arrive at your goal. They are not the same word, and they don't even point in the same direction. The thing that feels dangerous, the bouncing, the red days, is mostly just the cost of being in the game. The thing that's actually dangerous is quieter, and we're about to name it. So if a wobbly chart isn't the real enemy, what is? There are 3 risks actually worth your fear. First, permanent loss, betting everything on one thing that can go to zero, which diversification quietly defends against. Second, being a forced seller, needing the money during a dip, so the temporary drop becomes the price you're locked into. And third, the sneakiest one, being so afraid of every swing that you stay in cash for decades and let inflation guarantee you fall short. That last one feels safe, and it's the most dangerous of all. Here's the twist that flips the whole thing. Once you stop confusing volatility with risk, those scary drops can actually start working for you. If you're still adding money every month, a falling market isn't a disaster. It's the same shares handed to you at a discount. The exact swing that terrifies the panic seller quietly rewards the steady buyer. So the question that really matters isn't how much will it bounce, it's a different one entirely. Do I need this money soon, or can I let time do its job? So here's the whole idea in one breath. Volatility is how much the price swings, loud, scary, and almost always temporary. Risk is the chance of a loss you never recover from, or of never reaching your goal. The crash on the screen isn't the danger. Selling into it is. Diversify, so no single bet can sink you. Only invest money you won't need soon, and let the bumpiness be the toll you pay on the road to actually arriving. If this finally separated those two words for you, the perfect next watch is our breakdown on dollar cost averaging. Exactly how to turn market swings into your advantage instead of your fear. And remember, this is education, not financial advice, so always do your own research for your own situation. Subscribe for more money ideas explained simply, and I'll see you in the next one.